Thank our witnesses for being here, and our ranking member, of course. More than a year has passed since our hearing on climate havoc in the insurance industry, upending housing markets, mortgage markets, and local property tax bases, and spilling out into the broader economy. That threat is just one of the systemic risks climate change poses to our economy and to our financial system. Since that hearing a year ago, things have gotten worse in insurance markets and worse for American families that rely on them. Press reporting, risk assessments, and further warnings are piling up. I'd reference in particular the recent cover article of The Economist magazine. As we heard in those original hearings, you need insurance to get a mortgage. Without a mortgage, most of our constituents could not purchase a home. What happens when insurance companies go bust, or don't renew policies, or pull entirely out of a state? Families lose insurance. They can't find a decent policy. They can't afford what's available. Some even pack up and move away. Some end up with state-backed insurers of last resort, which may or may not be solvent. Some end up with small insurers, which may or may not have the resources to pay claims. This is what we've begun to see in multiple states. One is Florida. 10% of our nation's homeowners live in Florida. Florida homeowners pay on average over $6,000 for insurance, the highest in the country. Indeed, more than 3 times the national average, which is $1,700. Florida's average premium has doubled between 2020 and 2023, and the trajectory is that it is going to get worse. This has put a strain on many Florida residents. They install hurricane windows and doors to reduce risk, but premiums continue. Are you tracking the charts? Premiums continue their upward march. They put off retirement or skip vacations. For some, such as Deb Wood and her husband, it is simply too much. In Florida, insured losses grew by 206% between 2003 and 2018. 2022 saw Florida residents file over 678,000 personal and commercial insurance claims. Over 40% were hurricane-related. NOAA predicts an 85% chance of an above-normal 2024 hurricane season with 17 to 25 total named storms and 4 to 7 major hurricanes. In 2022 and 2023, more than a dozen insurance companies left the Florida residential market, including national insurers like Farmers. Residents fled to Citizens Property Insurance, the state-backed insurer of last resort, which ballooned from a 4% market share in 2019 to as much as 17% last year. If it has to pay out claims that exceed its reserves, Citizens can levy a surcharge on Florida insurance policy holders across the state. Good luck with that, particularly if the surcharge grows to hundreds or even thousands of dollars. To depopulate its books, Citizens has let private insurers cherry pick out its least risk policies. Those private insurers may have problems of their own, as we will hear today. This all looks like an insurance market that is swirling the drain. As one of our witnesses put it, and I quote, "Unreliable insurance could result in a situation where large climate shocks may cause property damage at the exact time that the property insurer becomes insolvent, increasing household default incentives and losses given default." End quote. What will the collision of increasingly unreliable insurance and greater mortgage defaults mean? Who will be left holding the bag? The federal budget takes a hit because these insurers and their policies are accepted by Freddie Mac and Fannie Mae, who either own or guarantee a large part of our $12 trillion mortgage market. This all sounds eerily reminiscent of the run-up to the mortgage meltdown of 2008, including a role of potentially captive or not fully responsible rating agencies. Florida is far from alone. A New York Times investigation found that the insurance industry lost money on homeowners coverage in 18 states last year. And the states may surprise you. The list includes Illinois, Michigan, Utah, Washington, and Iowa. Insurers in Iowa lost money each of the last 4 years. This is a signal that hurricanes and earthquakes, once the most prevalent perils, are being rivaled by hail, windstorms, and wildfires. Last year, the U.S. experienced 28 separate billion-dollar extreme weather events. Over the past decade, 28 states have been hit by such events more than twice in a year. I should say twice or more in a year. 38 states were hit in back-to-back years, and losses are expected to climb. So too will premiums, that is, where insurers are even willing to stay. In one example, the premium on a $250,000 home for a 40-year-old couple with a combined good credit rating and clean claims history would increase by as much as 63% in Louisiana and 61% in Nebraska. To borrow from the Times article, quote, "The question facing insurance companies around the country and the homeowners who rely on them is which state might be heading in the same direction as Florida. The answer from our reporting, it could be any of them." End quote. Or as a former state insurance commissioner said, "We're marching toward an uninsurable future." This isn't all that complicated. Climate risk makes things uninsurable. No insurance makes things unmortgageable. No mortgages crashes the property markets. Crashed property markets trash the economy. It all begins with climate risk, and a major party pretending that climate risk isn't real imperils our federal budget and millions of Americans all across the country. I'll just add in closing that the scale of the exposure that we're talking about today and the paucity of our response and the numerosity and severity of the warnings we have heard from responsible people, and the role of underinsurance and potentially unreliable ratings from rating agencies is really ringing a lot of alarm bells with me of what we looked like going into 2008.